In assignment 9.10, we have the balance sheet from end of 2014 here, and we have the income statement budget for 2015. And we have some assumptions here, the different turnover ratios, and some changes in short-term liabilities and so on. So first question is to make the liquidity budget, and we start here with what they call earnings contribution. It doesn't exist outside Denmark, so I prefer to call it profit before depreciation, but it doesn't matter. We take this from the income statement. We calculate here the stocks sales of costs divided by the ratio, stock ratio. And then we have beginning stock, we have year-end stock, and because it decreases, we have a plus on our liquidity. The same here, we take the revenue and divide by the ratio, and then we have an increase in debtors or trade receivables, and an increase of this assets is a minus. We have change in creditors. Here we calculate the purchasing, what we are purchasing, and we divide by the ratio. And we have a small increase in creditor, and if a creditor increases, it will give us liquidity. It's a plus. Then we are told that other short-term debt will decrease by 200. It's a minus because we have to pay it. We have interest cost from the income statement, and then we have liquidity from operations, 3.916. Then we have investments, and here it's important that we take the total investment of 800 plus 400, although it's not paid, but we should send the signal that we have made this investment of 1,200 altogether. And then we have here a new loan of 600 because we only paid half of the 1,200. So we have to establish a new loan. So the 1,200 is a minus, the 600 is a plus because it's a new loan. So the netto effect of these is a cash decrease of 600. And then we repay 50 on long-term debt. So the total cash flow during this year is 3,266. We had 100 in cash beginning of the year, so we end up with 3,366. Then we can make the new budget end of 2015. We here have the total fixed assets 6,500 from last year, plus 1,200 new assets, minus depreciation of 2,400. So we end up with 5,300. Then we have this from the liquidity budget. We have this one from the liquidity budget. 300 in other receivables are unchanged, and we have the trade payables from the liquidity budget. So altogether we have assets 18,566. Then our share capital is unchanged, and retained earnings increase from 6,550 to 8,805 because we have to add the profit for the year. So total equity is 9,805, and then we have long-term debt. It decreased by 50, so it's 1,400. We have a new loan of 600, overdraft facility, what we are allowed to draw on our bank is unchanged to 850. Then we have calculated in the liquidity budget our trade payables, and then we have other short-term debt, 380. It was last year 580, but it was reduced by 200. So total liabilities 18,566. So we have a balance. Question B, the purpose of the liquidity budget is to determine liquidity consequences of the activities. Of course. It's also an important thing to see if it's possible to make our plans. Yeah. Then how could we improve liquidity? We could take a new loan. We could try to reduce credit terms to our customers, or we could try to decrease stock. We could maybe try to lease the new machinery instead of buying. And maybe we could extend our credit terms to the suppliers. Then what will happen if we reduce our credit to our customers from 36 days to 20? The effect will be the following. For the moment, we have revenue 48, and we have rate of turnover of 18. It's 300. Sorry, this is the new situation. The new rate of turnover will be 18. So average debtors will be 2,667. Before we had 36 days of credit, it was a ratio of 10. So before we had this trade receivable of 4,800. So the difference between what we had before and what we will have if it's only 20 days of credit, it is 2,133. So we will reduce our debtors with 2,133.